This is the weekly market analysis for the week ending December 6, 2008. So last week we ended the month of November, and we're going to start off with a 10-year monthly view. Now you can see the market managed to retest, or close to retest, this support level back in 2002, at least for SPY. Volume has definitely picked up on the selling side, so you know this is a strong downward momentum. Okay, there's nothing weak about this move. Now from last month, this candle right here, you can tell how the bearish momentum is slowly dying down. Now this is the current month candle, and we won't know until the end of December what this candle will look like. But you can see from the three previous candles how the first two at least, we have very large dark body candles. But on November, you can see how the shadow, this lower shadow, is much longer than the previous two, indicating that the bulls are managing to push up prices a bit higher after tagging this support right here. Okay, so a dwindling bearish momentum, especially right when it touched support right here. And so you know that this is building up as very critical support. If this breaks, then we know the market can definitely head lower. Going into a 3-year weekly view, we managed to tag or finish the last leg of this move right here, tagging roughly around 74, I believe. Looking at the indicators, you can see stochastic is coming out or moving towards the positive side, and also the MACD is not showing a little bit of divergence. Notice how we made a new low, but the MACD is not lower than this previous peak. It's actually moving towards the center, so you know that the bearish momentum once again is slowing down a bit. This previous week, let me zoom in a little bit. Previous week we had a nice large white candle covering this one, and I would say it doesn't exactly look like a bullish engulf, but you can pretty much tell that this is a bullish type of setup where you have prices almost covering entirely the large dark candle of the previous week. Now this week it's all about consolidation. We've managed to consolidate sideways pretty much for this entire 5 days, and you can see with this small body candles, and that's what it represents. Okay, next going into a 6-month daily. Okay, so if you notice anything about this week, it's all about a shift in momentum. If we went back, let me take away the studies. If you look back in the charts, you notice every time the market managed to pull back or rally a bit, the bears pushed it down. Right, they sold hard and made new lows. Right, pulled back, sold off, pulled back, sold off. Okay, now we had a nice pullback, but guess what's happening? The bulls are managing to hold on to support level. In this case, it will be 82. Okay, after Monday's large sell-off, we managed to stay above 82 and even testing it a couple of times. So either one or two things are happening. Either the bears are getting weak, or the bulls are getting stronger, or it can be both. But either way, we're establishing a higher low right here. As long as 82 holds, then this will be our higher low. All we need is a higher high, which is a break above 90. And if that's the case, we will have what's called an uptrend by definition, right? Higher highs and higher lows. A downtrend is a series of lower lows and lower highs, which we had back here. So in some sense, the market is in some critical level right now, with support at 82, resistance, immediate resistance at 88, and then the next level, the ultimate one, is at 90. If it can break above 90, then we know we can probably test 100 again. Okay, to get a better view of the side trending action, we go into hourly view, 60 minutes. So once again, starting from Monday to this Friday, you can see how we've been just stuck in a range between 88 and 82. So these two are our immediate resistance and support. If 82 breaks, like I said, most likely we will come back and test this area of 74, 75. If 88 breaks, we probably head to 90, even higher. I'm assuming we're probably going to tag the 50-day moving average if the 90 level breaks. That could be your next resistance level. And based on Friday's action, it is leaning towards a more bullish tendency than a bearish one. At least that's what I can see from the market. So these are the levels to be watching for, 88 and 90. And the last thing we want to look at is the VIX. The VIX has been building up pretty good support at 60. As the market side trends, so did the VIX. Now, You can see how the VIX has been able to use this 50-day moving average as good support. Every time it came back, tagged it, it bounced higher, right? Just like here and here. So the 50-day moving average is going to be the ultimate level of support. If it breaks the 50-day, then you know the market can head higher, and at the same time the option premium will decrease as well. You can also tell just by looking at the moving averages alone. Notice how it's very widely separated right here. Okay, that's strength, that's momentum right now. But currently you can see how it's starting to narrow. Okay, it's losing steam, or in other words, it's contracting or consolidating, whatever you want to call it. But you know that the upward momentum in the VIX it's not as strong as before, which indicates that the bearish momentum in the market is not as strong as before. So overall, as far as the market and trading, I would lean more towards bullish trades than bearish trades, only because I think we did more or less hit some type of bottom around 75, 74 back in November. Okay, so this rally will probably last, I would say, a good 2 months or so. Okay, but just remember, overall, if you look at the overall trend, it's still down. So we're still in a bear market, and within bear markets there are bear market rallies, and these rallies tend to last a few months if they're strong enough. Okay, and this could possibly be one of them. But once again, I want to emphasize, just watch out for these levels to break. If we do get a break above these levels, then that's a good confirmation of that happening.